It's time to move on to the third step, performing tests of controls. What conditions must be met in order for the auditor to test the controls? Well, first, the client has to be using some controls. And second, the auditor must be able to link or relate the controls to one or more financial statement assertion. Why do auditors perform tests of controls? To evaluate the control effectiveness. This E word, effectiveness, is key to the tests of controls. Recall that earlier I mentioned during the understanding phase of internal control, the auditor is not evaluating for control effectiveness. The auditor is merely obtaining information about whether there might be any controls to test. Tests of controls test the operating effectiveness of the internal controls by answering 3 questions. 1. How were the necessary control procedures applied? 2. By whom were the control procedures applied? And 3. Were the necessary and applicable controls consistently applied? The ultimate purpose of testing the controls is to provide the auditor with the evidence to assess control risk below maximum when the controls are operating effectively and at maximum when they are not. There are 4 techniques to tests of controls. 1. Inquiry. 2. Observation. 3. Inspection. And 4. Reperformance. Inquiry alone is not usually sufficient evidence to support effective internal controls. Combine inquiry with one or more of the other techniques. Observation is the best technique to test for segregation of duties. However, be careful, auditors. The client may perform differently when not being watched. For information on how to select the items to test, please listen to CD number 5, Audit Sampling. A detailed discussion of attribute sampling for tests of controls is provided. When do auditors perform tests of controls? Usually at interim, which means during a time period before year-end. How many transactions should the auditor test? It depends on the auditor's judgment. Recall, the auditor only wants reasonable assurance from the controls, which in this case means that the cost of the controls should not exceed the benefits to be derived. In what situations would the auditor decide not to perform tests of controls? 1. If the client is not using any controls. 2. In the most unusual case where performing tests of controls would be more expensive than performing substantive tests. And 3. When the auditor is unable to link or relate the controls to one or more financial statement assertion. An example of a test of control is a situation where an auditor is testing for the financial statement assertion completeness. The auditor would inspect, a technique for tests of controls, signatures on canceled checks, and agree the signatures to an approved check signing list. When 2 signatures are required for large amounts, the auditor would verify that all checks over the limit have the proper 2 signatures. After performing the tests of controls, the auditor is ready to move to the 4th and final step, reassessing the control risk. When there are numerous deviations from the prescribed control procedure, the auditor will assess control risk at maximum, increase the amount of substantive testing, perform the substantive tests closer to the balance sheet date, and obtain more outside third-party evidence to support the account balance. If the tests of controls do in fact support that the controls are operating effectively, the auditor will assess control risk at below maximum and reduce the amount of substantive testing. Don't forget, the auditor uses the acceptable level of detection risk to determine the nature, timing, and extent of the substantive tests to be performed. Yes, the details of understanding and assessing control risk are numerous. Now let's move on to the second major control area that is tested, the transaction cycles. Auditors must be able to identify the control problems in various systems. Candidates must also be familiar with the forms and document flow. Due to time constraints in this CD, I will cover the three major control transaction cycles. 1. The sales revenue system. 2. The purchases system. And 3. The payroll system. Since there are other systems tested, please consult a current, no older than 1 year, Wiley text for document forms, flow, and other system examples. Supplement this CD by working previous CPA exam questions presented with answer explanations in the Wiley Auditing Module 2. The typical sales revenue system contains 8 major departments and activities. CPA candidates must know the 8 departments in the proper order, for many questions center around the departments and their activities. The 8 departments are: 1. The sales order area. 2. Credit approval. 3. Inventory control or the warehouse. 4. Shipping. 5. Invoicing or billing. 6. Accounts receivable. 7. General accounting. And 8. The treasurer's office, where the cash receipts are collected and deposited. Be aware that if one of these activities, such as credit approval, were to occur out of order, the internal controls would break down. For example, would you want a client to ship the merchandise before the customer's credit limits were checked and approved? In addition, watch for proper segregation of duties. Don't let the sales department approve credit. Always segregate the duties of custody of the cash, or in this case merchandise, from the recording functions of accounts receivable, recording in the subsidiary ledger, and general accounting, who maintains the general ledger. From the authorization functions, such as approving credit and then later billing and invoicing for the goods after they have been shipped. Segregate custody, authorization, and recording. Don't worry about differentiating a manual accounting system from a fully integrated computerized system. It doesn't matter what method is used to process the transactions. The key controls are still the same. Candidates, please remember the following key controls for a revenue sales system. Credit is approved by a separate credit department before goods are shipped. Written policies and procedures are approved in accordance with management's authorization. The shipping department is separate from receiving and the warehouse. Forms are pre-numbered and periodically accounted for. Sales returns are returned directly to receiving. Use a credit memo form when customers return goods. Treasurer authorizes bad debt write-offs. At least monthly, the subsidiary ledger is reconciled to the control account in the general ledger. Restrictively endorsed checks for deposit only to the company. Internal auditors reconcile and/or review the bank statements. Monthly statements are sent to customers, even those with 0 balances. Someone independent of the accounts receivable function reviews errors, corrections, and questions about monthly customer statements. Bond employees who handle cash and inventory. Deposit cash daily. Encourage the use of a lockbox system. Remittance advices should accompany customer payments.